Welcome back to the TD Ameritrade Network. I'm Oliver Rennick. We've got a big holiday season coming up as expectations for the consumer are high. Let's talk stocks that might benefit. Chris Versace from Tematica Research is the CIO. Joining us also in studio is Tom White to do some trading here. So, Chris, cheers. We're almost there to the holiday season, all right? Thanksgiving's around the bend, and then things pick up quick with the music and all that. What do you want to own when the music goes on?
That is right. Happy holiday season to you, Oliver. We're at that point of the year where we're getting a lot of different forecasts, everything, calling from up 3% to 5% year over year. Of course, you have to parse the details. Is it November, December, or does it bleed into January with the big return season? So be sure to check your forecasts. The big takeaway, no surprise, is the continued shift towards online shopping. We continue to like Amazon. We like UPS as a derivative. We also see gains by Walmart, Target in those categories. So all in all, very good expectations. I think the bigger question, Oliver, is whether or not the consumer can actually afford to open up those wallets and meet those expectations.
Now, this is interesting, Chris, because a lot of people go, well, wait a second, hold on. The consumer is the backbone of not just our economy, but the global one. That's been the narrative for the last 7 months. But I'm with you. After what we've seen from some of the consumer stocks, it's like maybe that trade is starting to move elsewhere.
Well, anytime expectations get very robust, Oliver, we tend to get a little nervous, right? Because everything is relying on it. And you are correct. When we look at the manufacturing economy, the industrial economy, it's contracting. So we're relying upon services and therefore the consumer to buoy the market. Yet, we're seeing December quarter expectations come in. When we back in July, December quarter expectations for the S&P 500 companies were up over 7%, October up 4%. Now they're up less than 1% year over year. So a lot of pressure on the consumer to deliver. And the big concern I have is the consumer balance sheet. We've seen debt just continue to inch up. We're hearing certain banks talk about rising delinquency rates, charge-offs. Gets me a little nervous going into the holiday season.
But not huge charge-offs yet. We saw from JP Morgan pretty stable.
Correct.
You're saying the trend is shifting upwards a little bit, and then you have support there, Chris, from the data. Does it mean, though, that you want to go as far to short some of the big companies like Costco, Walmart, Target that have all taken the lion's share now of e-commerce? Amazon, too, if I didn't say that.
I mean, think of the group that you rattled off there, right? Amazon, clearly going to be a beneficiary from the accelerating shift towards holiday shopping and digital shopping in particular, especially since we have a compressed holiday season this year. Walmart, the same. Plus, remember, Walmart is the largest grocer, and we are in that time of the year, as I like to say, for seasons eating. So I would definitely not go short those names. I would continue to hold them. And Costco, I was in over the weekend, and Oliver, I got to tell you, not only was it packed, but they are ready for the holiday season.
Yeah. Okay, so Chris, when we see the run behind them, are there any names that do look suspect that you want to steer clear from? I'm not going to put words in your mouth, but I'm looking at this giant rally in Target last quarter, and it was wild. I mean, they did 20% in like a day. Is some of the stuff getting excessive? Are there companies you want to get in front of?
Well, I think you want to remember, too, that Target is not only benefiting from the transition in their business. Really, they've pivoted and they're reaping the benefits now. But remember, too, that they also bumped up their dividend. That was one of the reasons that we wrote about them in a favorable tone over the last several weeks. So, again, rising tide is likely to lift all boats. I would not, repeat, not be stepping out of the way of these names.
Yeah. So, Chris, is there going to be then a risk here where we flop kind of on this quarter like we did in 2018? The Q4 expectation for the holiday season came up short, but we had a big market sell-off right before. Right now, it looks like we've got much healthier markets than we did in October. Or I guess that's a subjective term. We've got higher markets, Chris. Should that make us feel better?
Well, I think we need to understand why the markets are racing higher as you're describing. There's a lot of enthusiasm, a lot of, we like to say at Tematica, hopium over what's happening on the U.S.-China trade front. We got some positive developments this morning, particularly emanating out of China. Of course, we need to see what President Trump and crew have to say. But expectations are that there will be some phase one agreement. And again, going back to my comments earlier about the consumer, anytime we see everything relying on one particular expectation, we get a little cautious. So, The point I'm trying to make here is that I expect the market will continue to run higher as those expectations for a trade deal continue to bubble forth. The risk I see is if something happens, whether or not the details inside that phase one agreement are not what everybody expects.
Okay, I want to bring Tom White here with us in studio. We're going to do a little trading. Stick with us, Chris Versace. Tom, how do you then want to get exposure going into this? I mean, because a lot of these stocks we're talking about have run pretty high, but let's say we get another nice period of spending from the consumer. You like his point about Costco.
Yeah, Costco. The only point that I'd push back against with Chris is every time I go into a Costco, it's crowded. It's too crowded for me. I don't like going there that much.
All right, that's because you don't like people.
Tom, you got to do the mall walks. You got to do the work and let the data talk to you. Come on.
All right,
I got you, Chris. But
putting your misanthropy aside, Tom White.
Yeah, to set up Chris's point here about maybe a continued move higher into Costco back towards those all-time highs, which are just above 307 a share. It's trading about 303 right now. I looked at a different type of option strategy. These are high-priced stocks that we're going to talk about today, Oliver.
Okay.
And I think using options to play them might be the way if you want to make a bias or an assumption on where the stock's going to go over a specific amount of time. And what I've got here in Costco is a condor trade, not an iron condor, but a condor trade, and it's all on the call side. So I'm buying the 302.5 calls, selling the 307.5 calls, which is right at or near that all-time high, and then selling the 312.5 call and buying the 317.5 call. So it's risk defined in nature.
Okay.
You're paying roughly about $1.65 debit for this. So you're buying one call vertical, selling another call vertical with a nice sweet spot in between there of 304.15 about, and about 315.85 on the upside. So you've got a nice range for Costco to push higher over the next 22 days. They don't have earnings until the 12th of December, so you don't have to worry about that event. But this is one way to take advantage of a slow grind higher, back to those all-time highs. Sweet spot in between 307.5 and 312.5 to the upside, but you are limited in risk, risking 165 to make a potential 335 per spread that you do.
Okay.
Stay in risk defined. And the risk reward is in your favor on this type of trade if the stock moves higher.
Okay. Now, one group that we haven't talked about here yet, Chris, I want to bring it back in, that has been so stable, has actually not been the e-commerce. It's been those that don't have to compete in e-commerce, like TJ and Ross. How do you like these compared to those that have run so far on the e-commerce side? I mean, is this a nice way to get consumer exposure and not have to bet on big spending?
Well, I think they are going to benefit from the holiday push. Remember, Oliver, that my comments about the concern and worry over the state of the consumer, and before I answer it, we're going to want to check today because this afternoon we get the latest consumer credit report. We're going to want to monitor that very closely. But as consumers continue to potentially get strapped a little bit, where are they going to trade down to? That's going to be your TJX. That's going to be your Ross stores. You can also lump Kohl's in there as well.
Yeah. Okay. Chris, I love it. Good to hear from Mr. Versace. We're going to do one more trade here with Tom. Chris is the Chief Investment Officer at Tematica Research. Tom, last point here, okay? Let's say to that point, e-commerce and some of the big runners that have been leading here start to fade a little bit. Let's go Amazon.
Yeah.
What if you trade this in a range? What if you trade it sideways like it kind of has been fighting for?
Yeah, and if you look at Amazon post the results last quarter, we saw what happened there with the stock, pulled back, rallied back, and there were some concerns about their growth rate in AWS. You got to realize that's becoming a huge, major part of this company. So what I looked at was a short iron condor. So instead of the condor example that we used for Costco, I did an iron condor where I wanted to stay in a range over a specific amount of time, and I picked the December 6th weekly series. So you'll start getting some results of Black Friday sales, early holiday shopping sales, but you've got a nice wide range in this type of position. Where it's the 1755, 1760 put spread you sell, and then you also sell the 1865, 1870 call vertical. It's an iron condor, it's short. You're collecting a credit at 250. Your risk is only 250 on this type of trade, Oliver. So risking one to make one is a pretty good ratio on selling a credit spread such as this. You got your break evens. About 1867.5 and about 1750 1750 and 50.
Okay.
1750, 5750 on the downside. So you got a nice wide range. You got about 70% probability that both of those, each one of those verticals is going to be out of the money at expiration, and that's what you want. You take advantage of positive time decay or theta in this type of trade.
Wide range on the
wide
trade.
range where as long as it stays in between those two verticals, time decay contracts the price of that so you can buy it back cheaper.
I mean, last earnings we saw that Amazon, it's hard to break Amazon in one direction in a big way. It dropped big and then just came right back in one of the most epic intraday reversals ever.
Right. Now, and if you're directional on Amazon, if you're neutral to bullish or neutral to bearish on this, just do one side of this. If you're neutral to bullish, just sell the put spread. Collect a credit on that. You're not going to collect as much credit. Or if you're neutral to bearish on it, where you think it's going to stay below maybe 1865 on the downside, then you can look to sell that one. You still stay risk defined by doing verticals. High price stocks like this, Oliver, stay risk defined because we know and what we saw on earnings, these stocks can move pretty violently.